Which is the better retirement plan for self-employed individuals, the SEP IRA or the solo 401k? Now, both of these plans have extremely high contribution limits, which means you can put some serious money away for your retirement. And higher contribution limits also mean higher tax benefits. As of 2023, you can put up to $66,000 into either one of these plans and deduct 100% of your contribution from your taxable income and pay lower taxes. And by the way, if you have a spouse, you may also be able to put up to $132,000 into either one of these plans and get twice as much tax benefits. However, there are some critical differences between both of these plans, which may make one of them the better option to you, and that is exactly what we're going to talk about in this video. I tax plan every single day for small business owners at mycpacoach.com. I share my real-world experience here on YouTube, and if you want to learn more ways to reduce your taxes, go ahead and subscribe to our channel. I walk my clients through the differences between solo 401k and SEP IRA plans all of the time, so if you stick around until the end of this video, you will have a pretty good understanding of this topic. So let's go ahead and jump right in. Key difference: contributing more money to retirement at lower income levels. Both the solo 401k and SEP IRA has the same maximum contribution limit, which is $66,000 as of 2023. However, your contribution is limited by the amount of income you earn, and one of these plans will allow you to earn less income and contribute more to your retirement than the other. So let's go ahead and break this down, starting with the SEP IRA. Now, the SEP IRA allows you as the employer to contribute up to 25% of your compensation to your retirement account, which means that you would have to earn north of $264,000 to contribute close to the maximum of $66,000. However, the solo 401k allows you to get more money in at lower income levels, and that is because the solo 401k plan allows you to contribute as both the employer and the employee, whereas the SEP IRA only allows you to contribute as an employer. SEP IRA only allows you to contribute as an employer, so the maximum annual contribution for employees in any 401k plan is $22,500 as of 2023, which you could use in your solo 401k. You can defer up to 100% of your income into a 401k plan up to the maximum contribution limit as an employee. Then, as an employer, you could contribute another 25% of your compensation from your business, just like you would in an SEP IRA, which means that you would only need somewhere around $174,000 in income to take the max contribution, because you would only need 25% of your income to equal $43,500 instead of the $66,000 like the SEP IRA. Now, whether you plan to make the maximum contribution or not is besides the point here. The point is that regardless of your income, the solo 401k will allow you to contribute much more at lower income levels. But on the other hand, if you already earn over $300,000 in income, then you may have no problem maxing out either one of these accounts. Difference: ease of setup and ongoing maintenance. When it comes to setting up and maintaining a retirement plan, you may be interested in choosing one with the least amount of complexity. One of the two options here are subject to a higher level of scrutiny, which includes annual filing requirements, additional fees, and other rules. And that retirement plan option would be the solo 401k plan. If you have more than $250,000 in assets in a solo 401k plan, then you would be required to file Form 5500 with your tax return. And if you somehow forget to do this or fail to file this form, you could be fined up to $15,000. So if you desire less complexity and fewer things to worry about at tax time, then the SEP IRA may be the better option for you. There are no annual filing requirements with the IRS, and SEP IRAs are widely known for their simplicity and ease to set up and maintain over time. In addition, SEP IRAs are believed to be more cost-effective than solo 401ks, but I am not sure if this is still the case, to be honest. For example, custodians like Fidelity do not charge anything to open, close, or maintain a solo 401k account on an annual basis. However, you may have additional fees, of course, if you get a financial advisor involved into either one of these accounts. Difference: time to fund the account. In general, you have until the tax filing deadline to set up your retirement plan for the prior tax year. For example, if this is March of 2024, you could still set up and fund a retirement plan for the prior tax year, even though the tax year has already ended. This can be very beneficial for business owners because it allows them to carefully make their contribution after assessing how their business performed for the prior tax year. However, there is one key difference with solo 401ks, and that is that only employer contributions can fund the account after the tax year has ended. Remember, solo 401ks allow you to contribute as both an employer and an employee, and if you wish to use the employee contribution, you must fund it before the tax year ends or before December 31st. Otherwise, your solo 401k contribution will be limited to the employer contribution for that tax year, which will work the same as an SEP IRA. Now, SEP IRAs can be funded after the tax year ends, but remember, SEP IRAs cannot make any employee contributions anyway. So the main point here is that both of these plans allow you to fund the account after year end, with the exception of employee contributions with solo 401k plans. Difference: higher Roth contributions. Most SEP IRAs and solo 401ks are set up as traditional accounts because this gives you a tax deduction for every dollar you contribute to your account up to the limit. However, some savvy investors like to take advantage of a strategy called the backdoor Roth, which allows you to convert some of your traditional IRA or solo 401k into a Roth account. Roth retirement accounts are typically funded with after-tax dollars, which means that you typically pay tax on this transfer. However, the benefit of Roth accounts is that your investment earnings grow tax-free, which means that you will not pay tax when you withdraw funds from your Roth account when you retire. Now, there are a number of reasons why people do this, but to keep this video simple, let's address the main reason why people use this strategy, and that is to bypass the income limitations that limit high-income earners from contributing to a Roth retirement account. You see, once you earn over a certain level of income, you cannot take advantage of the Roth retirement account by default, but you can take advantage of the Roth if you go in from the back door. There are no income limitations when you set up a backdoor Roth, but the amount you can contribute varies based on the type of retirement plan that you have. So let's talk about it. Under an SEP IRA, you can only transfer up to $6,000 to $7,000 of your traditional IRA into a Roth IRA, whereas under a solo 401k plan, you can contribute up to $66,000 into a Roth 401k account. And the great part of this is that your contributions to a Roth 401k is not necessarily limited to your income like the traditional solo 401k. So hypothetically, you can set up a traditional solo 401k account and contribute the maximum amount that your income allows you to do. Then, if you are still under the max retirement contribution limit of $66,000 as of 2023, then you could contribute to your account with after-tax dollars, which goes into your Roth, which then allows your investments to grow tax-free. If none of that made sense, then take a look at this example. Let's say you earned $100,000 in income. By default, you would have an employee contribution of $22,500 and an employer contribution of $25,000, making your total 401k contribution equal to $47,500. Now, if the max contribution limit is $66,000, then you could contribute another $18,500 into a Roth under the backdoor Roth strategy. Now, all of a sudden, you're getting both a tax deduction for your traditional 401k contributions, and then you're also getting tax-free earnings on your Roth 401k contributions. But this is only possible if you use the solo 401k plan. All right, folks, so these are the biggest differences between the solo 401k and SEP IRA. In short, the solo 401k is far more beneficial than the SEP IRA from a contribution and tax perspective. However, it is far more complex. If you desire a simple but still very effective retirement plan, then the SEP IRA may be a great option for you. In any case, consult your CPA if you are seriously considering any one of these plans. And if you need a CPA, then apply to become an exclusive client of mine today at mycpacoach.com. In short, the solo 401k offers more flexibility and tax planning opportunities, while the SEP IRA keeps things simple and low maintenance. The right choice comes down to your income, your long-term strategy, and how involved you want to be with managing your plan. If you're serious about optimizing your taxes and retirement savings, talk with a CPA before making a final decision. Thanks for watching, and I'll see you in the next one.